Hey everybody, this is Ryan Mallory with the Stock Market Bubble Update. All the major indices were up this past week. That includes the S&P 500, the Nasdaq, and the Russell 2000, with the Nasdaq being up the most at 4.2%. That was done in large part because of the FANG stocks, Facebook, Apple, Netflix, and Google, and Apple. Yeah, Apple, I almost left that one off, the biggest company in the world. Nonetheless, those stocks all took off. And these have been stocks that, for the most part, probably besides Apple, had been just stuck in a sideways pattern for months and months and months. Google started to show a topping pattern, a head and shoulders pattern, but now it's shooting it back up to all-time highs. So the FANG stocks really carried the water for the market this past week. Now, I call it a stock market bubble update because we are in fact in a stock market bubble. Does that mean that we stop trading stocks? No. Does that mean that we acknowledge that we're in a stock market bubble? Yes. Does that mean that we start shorting stocks? No. Does that mean that we're prepared? Yes. So essentially, by calling it a stock market bubble, we're acknowledging the fact that it's a stock market bubble. But that doesn't mean that all of a sudden you start shorting the market just because we're in a bubble. Bubbles often last a lot longer than what you would ever expect. That's the very essence of a bubble, is that it keeps going higher than anybody would ever imagine, creating, therefore, a bubble. And we're seeing it across so many stocks. And we'll get into those later. But first, I gotta tell you about the YouTube membership channel just really quick. Below, click join. You're gonna get all my market updates each and every week. That's going to include updates on the S&P 500 multiple times, the Nasdaq, and on the Russell. You're also going to get updates on all the FANG stocks, plus Microsoft, plus Tesla. And you're going to get multiple updates on my master watch list for both bullish stocks and bearish stocks, including daily setups and the most intriguing charts each and every day. So check it out, join below, and you'll get all of that for yourself. Now look, acknowledging the fact that we're in a stock market bubble, the goal is not to get out at the top. And it's not to get back in at the very bottom. When we're trying to get out at the very top and get back in at the very bottom, that creates problems for us as traders, because oftentimes that leads us to getting out prematurely and getting back in prematurely. And we don't want that. We can ignore the fact that we're not going to get out at the top, and we can ignore the fact that we're not going to get in right at the bottom. What we want is the bulk of the move. And I talk about this in all the videos. We want the bulk of the move. We don't care about the top. We don't care about the bottom. We want the gist of the move, okay? The meat and the potatoes. And saying that is not sexy. It basically requires me and anyone who believes in what I'm saying to acknowledge the fact that, hey, we're not perfect. We're not going to be perfect traders. And I get that's not people's first choice. People's first choice is to maximize their profits to perfection. And you can't be perfect in the stock market. And knowing that I'm not people's first choice, I'm usually their second choice. They come to me after they've blown up their accounts, after they've screwed up because they stayed into these momentum stocks for far too long, trying to nail the tops because they shorted a market that wasn't willing to be shorted yet. That's when you guys start listening to these videos and realizing the market isn't a field of just beautiful roses. It's got a lot of pitfalls, a lot of traps, and a lot of thorns. Next week and the week thereafter is critically important for the tech sector and the market as a whole. You have major earnings reports coming out. And what we've seen out of Intel and what we've seen out of IBM so far is that the markets are selling off on these earnings reports. You're seeing it in the financials. The financials have pulled back as well. Goldman Sachs, Bank of America, Citigroup, they're all pulling back. Now it becomes a much bigger deal if your tech stocks start doing that. Now, next week, on the 26th, you have Microsoft, a $1.6 trillion company, reporting earnings. On the 27th, the next day, you have Apple reporting earnings, a $2.2 trillion company. And on that same day, you have Facebook, a $700 billion company. And you have Tesla, an $800 billion company. And then the following week, on the 2nd, you have Google reporting earnings. They're a $1.2 trillion company. And you have Amazon, a $1.6 trillion company, reporting earnings on the 4th. What does that all mean? That means you have $8.1 trillion worth of companies reporting earnings. The impact that can have is ginormous. The value of those companies is equal to that of 1/3 of the entire United States gross domestic product. And if they follow the same path that your tech stocks followed, well then, guess what? Tech stocks are going to sell off massively. And if tech stocks sell off massively, then your entire Nasdaq 100 is going to sell off massively. And if Nasdaq 100 sells off massively, then the Nasdaq Composite's going to sell off big time. And if the Nasdaq Composite sells off big time, then the S&P 500 sells off big time, and the entire market sells off big time. So it's going to be critical that these companies meet or exceed their expectations. And if they don't, that Wall Street gives them a pass, just like they did all of 2020. So let's get into the charts here, okay? Starting off with SPY, this is the S&P 500 ETF. I'm showing you the hourly channel here because I think this is the one that's critically important at this juncture. You have a beautiful and pretty much perfect rising channel going on here with the SPY. If those earnings start to come in pretty negative you're going to need to watch this bottom channel and can it hold? It's about a 3% drop if it does. If it can test it and hold it, then it leads to an incredible bounce opportunity and an opportunity to get in at stocks that have sold off a little bit, okay? But if this doesn't hold, then we need to look at a possible 5% pullback that goes off of this rising trend line going all the way back to the March lows. If this trend line can hold it together, then you have a retest at 365, which is about a 5% pullback, a little bit less, but about around 5%. This 5% pullback possibility coupled with this 3% possibility is really the two support levels that you need to be watching right now in the stock market. Now, I talked about this rising channel on the hourly chart. Watch it, because right now the market continues to butt its head up against that rising channel. Until it can break through that rising channel like what the Nasdaq has done, then the potential for a strong pullback to this rising trend line on the hourly chart remains a very, very real possibility. Now, as for the QQQ, this is your Nasdaq 100 ETF. You got the rising channel. The cool thing is that QQQ is, unlike the S&P 500 or SPY, has managed to break out above the rising channel. We haven't seen that yet from SPY. So if it has any kind of a pullback, it needs to make sure that it can hold that rising channel. But if it can't, then 315 becomes a very logical testing point for QQQ. That becomes around about a 3% pullback. If that 315 area can't hold, then you need to start watching for a potential pullback to the support on the hourly chart going all the way back to last March's lows. Now, last March's lows is going to represent a pullback to around somewhere between this like 303 to 307 area. That's going to represent about a 7 to 8% pullback, which makes sense because if the tech earnings disappoint, the Nasdaq's going to pull back much more than the S&P 500 because the S&P 500 isn't so tech-centric as the Nasdaq. Now, what about the Russell? Well, you got this incredible box consolidation going on right now, going back to mid-January, where the stock is just bouncing back and forth in between. Now, you also have this relationship between the Russell 2000 and the Nasdaq, where when the Nasdaq is performing really strong, particularly the Nasdaq 100, your Russell 2000 and the stocks that are included in it are pulling back. That's because a lot of your FANG stocks, which represent a huge part of the Nasdaq 100, are your place for safety in the Nasdaq. So when the market sells off, a lot of capital is flowing into those FANG stocks as a haven of safety. Whereas the Russell 2000, those are more of your growth stocks, and people are pulling their money out of it when they're becoming more concerned with the overall market. So watch this little box pattern right here. If it breaks out, then we should see another leg to the upside for the stock market. However, you have this incredible trend line off of the November 2nd lows, and the Russell is so overbought, it's not even funny. I mean, you're literally looking at 43% in gains on the Russell 2000 since November 2nd. So if there is a pullback, or if there's a huge rally in the FANG stocks next week, there may be weakness in IWM. So you could see a pullback all the way down to this 205 area, which would be the rising trend line off of those November lows, and provide a really nice bounce opportunity. So watch for that pullback back to the 205 area and see whether or not it can bounce to get long on that. And I'd be remiss, right, if I didn't talk about some of these stocks that we've seen just going through the roof. You got GME, you've got PLTR, and these two stocks have just seen enormous buying interest this past week. But let's talk about these two stocks real quickly here. The FOMO is real out there, the fear of missing out. We want to be in these stocks because everybody else is making money off of these stocks, and we're thinking, if everybody else is making money off of these stocks, why am I not making money off of these stocks? It's simple, because you can't control the risk in these stocks. If you're holding GME over the weekend, yeah, it could gap up to 80 to 90 to 100, maybe $200 by Monday. But the downside is that it could also gap down to $35 or to $40, or even worse, maybe it goes down to $20, and you can't control that kind of risk. And when you can't control the kind of risk, it's not worth getting into. There's too much risk here. And I know people are printing money on these trades, but if you're looking to be a successful long-term trader, it's not going to come down to whether or not you were in GME, if you were in PLTR, if you were in Hertz, or in Kodak. And since we're talking about Kodak, and since we're talking about Hertz, let's look at those charts for a second. Do you remember HTZ, which is now HTZGQ? Remember that little pop back in June where it goes all the way from like the ones all the way up to the sixes? Guess where it's at back now? It's right back in the ones. Well, let's talk about Kodak. Oh yes, Kodak. It goes from the single digits all the way up to $60, $62 a share. Where is it back now to? The single digits. Guys, the same thing's going to happen with GME. It's going to come back down. And I know that a lot of us have maybe more confidence than what we should have with our trading abilities. I'm not one of them. I always think that I can blow up my account any day of the week. And that's what guides me as a trader, is the fact that I'm a fallible human being that can blow up my account. And I don't want to be in the situation that finds myself buying Kodak at $60 a share only to find it back down to $17 or $18 a share. That's game changing. That takes you out of the the whole entire stock market. Don't do that. You're looking at sustainability. And when you're looking at GME here, guys, it's at $65 a share. It wasn't too long ago, it was trading in the single digits. It will come back down again. I don't know when. Maybe, like I said, maybe it blows up to $200 a share next week. But can you reasonably manage the risk? You'll tell yourself, well, I'll just get out. But once you're in the trade, you'll start telling yourself, oh, I'm just going to wait it out a little bit longer. And it's that waiting it out a little bit longer to think that you have an idea for the stock that the market doesn't hold, that it's going to start pulling back on you. And then you're saying, well, once it gets back up to where I was before, I'll get out. And it never returns. So don't trade these stocks, guys. They're killers for your portfolio. I'm not saying that there isn't some people that are going to make money off of them. I get the whole premise behind these things. But as a whole, you can't sustain a trading career off of these kinds of stocks. So don't do it. If you enjoyed this video, I would encourage you to like and subscribe. Just click the like button, click the subscribe button. It helps me to continue to provide excellent content each and every week. And I have great plans for this channel going forward. I want to hear down in the bottom, did you buy into GME? What's your plans going forward? I want to know, are you still holding it? And if so, what's your plans? When are you going to get out? I'm genuinely interested in knowing this. If not, tell me how you did in the FANG stocks this week. I'd love to hear. Thank you guys, and God bless. Is this green screened? This Mountain Dew? I don't know.